You have been making your mortgage payment for years. Your property has gone up in value, but here is the question most commercial property owners never stop to ask. Is your current loan actually costing you money? Because in commercial real estate, the wrong financing structure or just all financing you have never revisited can quietly drain tens of thousands of dollars from your return every single year. So today we are going to talk about when it actually makes sense to refinance a commercial property and how to know if the timing is right for you. Hi, I'm Helena, commercial real estate advisor based in Central Texas. I work with business owners, investors, and entrepreneurs on warehouse space, commercial land, and multifamily properties. And one of the most common conversations I have, especially with people who have owned a property for a few years, is about refinancing. When is the right time? What is the actual benefit? And what do you need to watch out for? That is exactly what we're going to dig into today. First, let's get clear on what refinancing a commercial property actually means, because it's a little different from refinancing a home. When you refinance a commercial real estate, you are replacing your existing loan with a new one. You might be going after a lower interest rate, or maybe pulling out equity you have built out, maybe even changing your loan terms, or maybe all three at once. Done it right at the right time for the right reason, it can genuinely reshape your financial picture. But done it at the wrong time, it can cost you fees, penalties, and lost momentum. So let's talk about the 5 situations where refinancing actually makes sense. The most obvious reason to refinance is when interest rates have dropped meaningfully since you took out your original loan. In commercial real estate, even 1% reduction in your interest rate can translate to significant savings, especially on larger loan balances. Here is a quick example. Say that you have a $1.2 million loan on a warehouse at 7.5% interest. Your annual interest cost is about $90,000. If you refinance to 6.25%, you are down to around $75,000, and that is $15,000 a year back in your pocket. Over a 5-year period, that is $75,000 in savings before you even factor in improved cash flow. The rule of thumb most advisors use is that if you can reduce your rate by at least 0.75 to 1 full percentage point, and your plan is to hold the property long enough to recover your closing costs, which on a commercial refinance typically runs from 1 to 3% on the loan, the math actually works. If you buy a warehouse, a piece of land, or a multifamily property around 7 to 10 years ago, there is a real chance your property is worth considerably more than what you pay for. That appreciation doesn't have to just sit there. A cash out refinance lets you pull out a portion of the equity you have built, which is tax-free because this is a loan, it's not income, and put it into work. You could use it to fund a second acquisition, renovate the existing property to push the rent higher, cover a business expense, or simply build your reserves. For example, an investor owns a multifamily property in Central Texas, bought it for around $650,000 and maybe it was 7 years ago. It's now appreciated at $950,000. A cash out refinance at 70% loan to value on the new appraised value, giving a $665,000 loan which paid off his original balance and puts roughly $150,000 in accessible capital into his hands, and that's equity converted into opportunity. This one catches a lot of commercial property owners off guard, especially those who are newer to commercial financing. Most commercial loans are not fully amortizing over 30 years the way a residential mortgage is. They typically have a balloon payment, meaning the remaining loan balance comes due in full after a set term, usually 5, 7, or 10 years. If your balloon is coming up in the next 12 to 18 months and you haven't already started planning, now is the time to act. You will need to either refinance into a new loan, sell the property, or pay the balloon in cash. Most owners refinance, but lenders need time. The property needs to appraise and your financials needs to be in order. Waiting until the last 60 days is a stressful position to be in. So don't let the balloon sneak up on you. Pull out your loan documents today and find the maturity date. If it is between the next 2 years, start having conversations with your lenders now. Sometimes refinancing isn't about rates at all. It's about restructuring. Maybe you originally took a short-term bridge loan to close quickly and always planned to refinance into a permanent financing. Maybe you are on an adjustable rate and you wanted to lock in a fixed rate before rates move. Maybe your original loan had a personal guarantee and you want to negotiate that out as you track records as a borrower has grown. For multifamily investors specifically, and this comes up a lot with clients who own from 5 to 20 units properties in Texas, refinancing into an agency loan through Fannie Mae or Freddie Mac can sometimes offer better terms, longer amortization schedules, and more favorable prepayment structures than a local community bank loan. It's worth understanding what options exist beyond however give you your first loan. The structure of your loan matters almost as much as the rate. A slightly higher rate on a non-recourse 25 years amortizing loan might be more valuable to your long-term goals than a lower rate on a short-term personally guaranteed note. This one is particularly relevant to multifamily investors and is a reason to refinance that most people don't immediately think of. When you do a cash out refinance on a property, the money you pull out is not taxable income. You are borrowing against equity, not selling an asset. That means you can access the value you have built without triggering a capital gains event. Compare that to selling the property, where depending on your cost basis, you could be looking at a substantial federal and state tax bill. For investors who want to access equity, deploy capital, and maintain their tax position, a refinance can be a slightly more efficient move than a sale. This is also where a conversation between your CPA and your commercial real estate advisor becomes very valuable. The two strategies should be working together. If you are making real estate decisions without factoring in the tax implications, you may be leaving a lot of value on the table. In the interest of giving you the full picture, here are the situations where refinancing probably doesn't make sense. If you are planning to sell the property in the next 1 to 2 years, the closing cost of a refinance likely won't be recovered in time. If your current loan has a prepayment penalty or a deficiency clause, both common in commercial loans, you need to calculate that cost before you assume refinancing saves you money. And if your property's value or your income has declined, you may not qualify for the loan terms you're hoping for, and forcing a refinance in a weak position can backfire. So the bottom line is that refinancing is a tool. This is not a default move. So run the numbers, understand your costs, and make sure the reasons are real. Quick recap. The 5 situations where refinancing a commercial property genuinely makes sense. Rates have dropped and the savings outweigh the cost. Your property has appreciated and you want to unlock that equity. Your balloon payment is coming due and you need a new loan. Your loan structure no longer fits your goals. Or you are looking to access equity without a taxable event. Any one of those is worth a real conversation. If you are sitting on a commercial property right now, a warehouse, a multifamily building, a piece of land, and you are not sure whether your current financing is still working for you, that's worth finding out. My team works with property owners across Central Texas on exactly these kind of questions, and we're happy to take a look at your situation and give you a straight answer. Send us an email at info@thecommercialdeal.com and tell us a little more about what you own and what you are trying to figure it out. We will get back to you personally. Refinancing at the right time for the right reason can genuinely change the trajectory of a commercial investment. But like most things in commercial real estate, the details matter. I hope this gives you a clear framework for thinking it through. If it was useful, hit subscribe. We put out practical content like this one regularly. See you in the next one. Ciao, ciao.